You wake up, check your phone. There's money in your account. But here's the uncomfortable truth. That money moved long before you even touched it, long before you earned it, long before you even knew it existed. And by the time you see it, most of the important decisions about it are already over. Let me show you how. Because right now, money is moving faster, farther, and with less human involvement than at any point in history. And understanding that invisible journey matters more than your budget ever will. Not because it's dramatic, but because it's quiet. And quiet systems are the ones that actually control outcomes. Let's start with a normal moment. You get paid. Your employer presses a button. You see a number appear in your bank app. It feels direct, like money traveled from them to you. It didn't. That money took a detour through a system built decades ago, optimized for institutions and almost completely hidden from the people who depend on it. Before your paycheck exists, your employer's bank already knows it's coming. The amount, the date, the risk. Banks don't wait for money to move, they predict it. So when payroll day arrives, the banks don't physically send anything. They update ledgers, digital promises, IOUs stacked on top of IOUs. What actually moves is trust, and trust is traded like a commodity. Your bank credits your account before the system fully settles because it assumes the other bank will pay. Most days, that assumption is correct. But that small assumption is the entire financial system. Now zoom out. Your bank doesn't just sit there holding your money. That would be inefficient, and banks hate inefficiency. The moment your money arrives, it becomes part of a pool, a massive, constantly shifting pool. Some of it is loaned, some of it is pledged as collateral, some of it is used to meet regulatory ratios, some of it is quietly parked overnight in markets you'll never see. This happens automatically. Algorithms decide where money sleeps each night, not humans. And this is where the story gets uncomfortable, because your money is most useful when it's not with you. Banks make money by keeping as little cash on hand as legally possible. That's not a flaw, that's the design. If everyone asks for their money at once, the system would break. So the system depends on something very simple: you not asking. Now let's go one layer deeper. Banks don't just lend your money, they multiply it. When a bank issues a loan, it doesn't hand over existing cash. It creates new money. That sounds fake. It's not. The loan becomes a deposit somewhere else. That deposit becomes the basis for another loan, and another. Money expands not when it's printed, but when it's promised. This is why central banks matter so much. They don't control money directly, they control the cost of promises, interest rates. Raise rates and promises flow down. Lower them and promises explode. And here's the irony. Most people think money starts with governments printing it. In reality,